So our first presentation today, we're delighted to welcome founder of Option Sizzle, uh, Bellinger. In this session, John will explain how volatility and time decay negatively affect your option positions, what you can do to offset them, and what you can do to increase your chances of profitability whenever you're right on your idea. So Josh, thanks for joining us. Please take it away.
Absolutely. Thank you for the introduction. And being the first person to speak with you today, I know that probably some of you were on yesterday, and being the first person to kick it off for you, I went through myself and I looked at some of the presenters, and one of the things that I always come across is that foundation for individuals, especially when it comes to options, focusing on that is going to make you much more successful. Everyone has a method, everyone has a different way of doing it, and you'll learn a lot of those strategies probably yesterday and also going forward. So really what I wanted to do with you with my time is to really help you understand and help you understand in more depth about how options work, because there is, move this here, off there. There's such a complexity to options that really keeps people on the sidelines and also restricts people from actually even making them worthwhile for them. So today we're going to talk about how to buy options without getting crushed by time decay and volatility, and more specifically what we want to understand is volatility. So like Greg said, my name is Joshua Bellinger and it's optionsizzle.com. That's what I started in 2008. So this is just a simple risk disclosure, and trading futures and options and currencies are a very substantial opportunity to lose all your money if not just a little bit. So just to make sure that you're aware of this, and I am not a registered advisor. This is just educational purposes only, and all this other good stuff that we should be talking about. So for those that are in attendance, and I'm going to have this a little interactive, how many of you have traded equity options in the past? And I'm going to look here on the little sidebar. So those that are, you can also raise your hand and also put into the chat box yes or no, just to make sure I see how many of you are familiar with options. Okay, looks like quite a few of you are, so that is good, and you should be, because options provide a substantial opportunity to be successful compared to stocks or mutual funds. So let me go back to my screen here as well. So for those that have answered yes, like myself, how many of you have just tried buying a put or a call for a directional play? So what I mean specifically is you thought Netflix was going to go higher in earnings just a couple days ago and you bought the calls. And this is a common theme with a lot of people, is that they do have this problem that when they play direction, what direction means specifically is that you are betting on that prices are either going to go higher or lower in that underlying. And this is where a lot of people get caught up on some issues. So how many of you feel that having this problem with buying options, and the problem being not buying the right strike price, not buying too much time, or not buying enough time? These are three things that are very complex for some people, even myself, of not buying enough time or the right strike. So these are kind of the three things that I really boil down to really understanding some of the fundamental issues that people have when it comes to options. And we'll go in a little bit more in depth going forward here, but I just want to make sure that you're all with me and it makes sense. So the stock moves in the direction you anticipated, Netflix being a good example, but you still end up losing money. You still end up losing money. How is this possible? And does this sound familiar? What if I told you that we could fix that every time you are right on your directional opinion, you end up making more money on virtually every trade? And I'm not joking about this. It's not magic or a secret strategy. It just boils down to understanding how options work, and this is really why I want to focus in on the foundation of understanding options on a much better platform. So my name, like I said, was Joshua Bellinger, and a little bit about myself. is that I started on the floor as a runner at the Chicago Mercantile Exchange when I was 19 years old. And it wasn't glamorous as you might think, working in the Mercantile Exchange and being a runner. I think the janitor had more of of a hierarchy than I did, but fighting through the pits, and this is where I started to learn about the marketplace. And from there, I was able to obtain my Series 7 license and became a stockbroker, which is ultimately what I wanted to become. And I shortly realized that wasn't as glamorous as I thought it was. It wasn't the boiler rooms at the Wall Street movies that I watched and try to mimic myself. Making 600 calls a day, opening clients on New York Community Bank and Chesapeake Energy wasn't what I really enjoyed. So from there, I was able to leverage, kind of option my my knowledge that I obtained, and I worked at a few trading desks in Chicago. And right before I started Option Sizzle in 2008, I thought managing clients' money was where I wanted to go, and that was far from the truth. It was a not so, again, glamorous position with the amount of stress and having to raise money as well. So all these things have led me into options, where I started to learn about it when I was on the Mercantile Exchange studying for my Series 7. I was one of the first people on the web highlighting unusual option activity, which caught the eye of Bloomberg, Businessweek, New York Post, Reuters, Dow Jones, and Yahoo Finance, and of course the Wall Street Journal, which I've all been quoted in for my findings of unusual option activity and other things related to options. So I don't want to refer to myself as the top expert, but I am one of them for my age. So before we go into this a little bit more, it's important that we run down some key terms and basics of options just to kind of get on the same page. So when you're buying an option, you're not just trading direction. You can still end up losing money if you buy calls when the stock price rises, or lose money from buying puts if the stock price drops. And this is really kind of a disconnect for some people, because a lot of those that have gone and made money with stocks, they come into the option market and they don't really realize the fact of why they're losing money. They think about the leverage that they receive, and then they put in too much risk, and especially when the price of that underlying goes in the direction like it did before with their stock, they don't understand why they are not making any money. So the movement of the stock price is just one component of how options are priced, and stock being underlining. So if we had talked about futures, I would have put underlying, but we're specifically just going to talk about stocks and use that. You also have to take into account the option strike price selected, the time expiration, and the implied volatility. So I'm going to repeat that. Price selected, your option strike, the time to expiration, or days to expiration, and implied volatility. So 3 components that many people don't think about when they go into options when they come from stocks. When it's all said and done, the option pricing model is simple, or I'm sorry, is a simple, or simply a probability model. So I'll repeat that just to be clear. The option pricing model is a probability model, and that's all it is. It's just a probability of this option going to expire worthless or likely in the money. Whenever you buy an option, you are also long. So buying an option means that you are long that direction. So it's important to understand the contract that you are. Put being you're playing direction to the long or to the downside, and then call side playing direction to the upside. Option volatility, aka implied volatility, in addition to time decay, is working against you. The reason why most traders lose money on long options is that they get the direction right. It's that they either misjudge the timing or implied volatility, or sometimes even both. So an option is composed of intrinsic value and also extrinsic value. I know, I think we're on slide 17 and we have a lot of terminology already thrown in here. So that's why, again, if we just kind of pause here, with options, this is the biggest hurdle that people have, and it's really disappointing, because if you understood options, as some of you do, the rest that are on the sidelines are not getting it because they don't want to, because the terminology and the understanding of all these components is complex to them. But if we take that and say, hey, look, the probability of being successful can be much greater with using options compared to stock, why wouldn't you want to increase your chances more than 50% as you would with stock? That brings up the mindset a little bit to those people of maybe I should pay a little bit of attention. But then when we start throwing all these intrinsic value and extrinsic value stuff at them, then that's where you start to get a little rocky. So at expiration, all options finish in the money or expire worthless. So it's important to understand that there is either an intrinsic value or there is an extrinsic value, and the extrinsic value is evaporated at expiration whenever that contract expires. So intrinsic value is what the option would be worth if today was hypothetically expiration. Extrinsic value is the time value and volatility component, the probability element of options, and that's where the pricing of that extrinsic value comes in. It's a probability. It could happen, but the likelihood of it happening, little iffy on that one. So if we take a look at Facebook on April 1st, 2014, and I'm not going to show you a chart. I'm just going to tell you what the closing price was. Is at 62.62. We are looking at the options that expire that same week. So these are weekly options. The 61 calls that were in the money were priced at $2.01. So again, 62.62. These are the 61 calls. These are in the money options that they're known as because it's below where the current pricing of it is. And the intrinsic value of that is about $1.62, and the extrinsic value is 39 cents. Now, if we look at the money, those were priced at $1.04. Now, the intrinsic value on that is 12 cents, and the extrinsic value is 92 cents. So in this example, like I said, the options were 3 days from expiration because these are weekly options. And notice how quickly the extrinsic value will get sucked out of the 62.50 calls if the stock price sticks around that price. We'll look at that on the other slide. But this is what most people will have a problem with, is that they look at this, and because they learn options 101 from Google, they think to themselves, well, I'm just going to go with that at the money, or even worse, the out of the money option. And if we break it down and understand these components, we look at this and say, wow, we get a lot more bang for our buck with the 61 call. Now, we're not going to say how this exactly works out because this is a very short option contract, and this is more essentially for a day trade. When you're working on a weekly time frame like this small, you have to be really, really understanding of your time frame and how quick you think the trade is going to work out. So this would be specifically for a day trade. And when we look at that $1.62, for a lot of people are like, well, why do I have to pay $1.62 when I can get that at the money? Well, the extrinsic value, that component, that probability component, is really what's going to affect a lot of people, and the reason why that trade is going to lose money, because that is all going to get sucked out of that option contract. This is kind of the padding of, well, the option, if it moves this far, we've already priced it in, and this is that extrinsic value. So let's look at the next one here. Only in the money options have intrinsic value. So it's a very good, that's why it's understanding and very, very good foundation, a very good foundation of understanding the intrinsic value and extrinsic value and working off of that. At the money and out of the money options only have extrinsic value. At expiration, we are left with the intrinsic value. So whatever that option, if it does have any value to it, it's going to be all intrinsic, which in some cases can still lose you money. But when we go into some more slides, we'll understand why that intrinsic value is very important. The deeper in the money option, looking at this one compared to another one, the more it will move along with the stock price. The stock moved from 60 to 61 from the following day. The option price of the call went from 10.15 to 11.15. So what I'm doing on this is showing you the comparison. It's just a simple Black-Scholes model, and there's a couple of them out there, but just for this exercise, we're just going to look at both of them on the block shows. And what I want you to do is on the outputs, you see that call price is 10.15, and then on the other side, the call price is $11.10. Volatility is very important when we look at this. So volatility is the same, which is never going to be the same typically, but what we're focusing in on is just price difference. So with all these little fill in the blanks staying the same, if the price moved from 60 to 61, that option went from $10.15 to $11.10. But these don't stay still. That's why it's important to understand, and we'll talk in some other slides about the volatility and the time and how those affect it. But again, days to expiration, it's only 1 day, and overall for that leverage, that in the money option, we still have a decent return. So let's look at one that is at the money or even an out of the money option, and how volatility and time decay play a much bigger role. So this is going to be the same, where volatility is the same. We move out a day, and we look at the call price on the left side, and it's $1.03. And then we look on the right side, it's $1.27. Again, this is the same move from 60 to 61. And you look at the delta here, if we go back here as well. So we didn't really talk too much about delta, and delta is really the key aspect to an in the money and out of the money option. So call delta on this one is a 95, so that's very deep in the money. So a stock is going to have a delta of 100. So being at 0.95, that's very deep in the money. It's very, very similar to a stock and how it's going to trade. If we go back to this slide, we look at the call delta on here. This is a 26. This is a very out of the money option. This is theoretically has a probability of success of about 75% of actually working. But for this one, it did work in that time frame, and it moved outside that that volatility. And you look here, yes, the return of it is much greater. However, these components that we talk about have to stay still, and they do not stay still, and that's very important. So you might be thinking, like I said, wow, that's pretty good. However, we are assuming that volatility remains constant, which it never does. What if it dropped 5 points instead? Just looking at these same calculations, the call price is $1.03 delta. We look at the same one, call price, it's all of a sudden 97 cents. But the delta is 28 cents. It's up, the delta's up 2 from the other slide. Looking at volatility, 40% compared to 35%. This is exactly why most people lose money with options when they play direction. When you buy a long option, you have to be very understanding of a volatility, where it's at, and how it actually works. Volatility is oscillating, so it's never going to be the same. And I'm going to explain this and say it many times, hopefully for you to understand, because it really is going to be critical to your success with options, no matter if you're selling options or buying options. So the stock moved from 60 to 61 like we had in the other examples. The option price of that call went from $1.03 all of a sudden to 97 cents. It's a losing trade when implied volatility dropped from 40 to 35%, which is typical to happen. And not even showing the time decay that's occurring on this as well, this is more of a losing trade. And this is why when we look a little bit further, when you trade at the money or out of the money options that are further out in time, you're making a bet that volatility stays that level or increases. In the last example, the stock price moved in our favor, in your favor, but the drop in volatility and time decay had a bigger effect on it. And that's why it's very important that we understand volatility and we understand the time, especially when we are buying options. Most directional traders or investors focus on technical analysis and price levels. They aren't sophisticated enough to predict the direction of implied volatility. And when I mean sophisticated enough is this, that they don't know. We only know that implied volatility is going to oscillate, meaning that it's going to It's going to go up and it's going to go down. That's one thing implied volatility will do. Understanding where implied volatility is at is going to be critical compared, and it's going to be different for every index and also every stock. And when you understand where those levels of implied volatility are, that's going to help you dictate what most people refer to as expensive or cheap. Now, that's a relative term, but when you know that implied volatility is at higher levels, there's ways to offset that, which we'll talk about in a few slides. So my examples here: symbol $64, price 215, change it up 112, and the volume, yada yada. These are all things that people would be looking at if they were trading a direction in technical analysis. With near-term options, the worst enemy of at-the-money or out-of-the-money options when buying premium is time decay. It's theta. That's the reference that option traders use for it. It's theta, the Greek. With longer-term options, the worst enemy of at-the-money or out-of-the-money options when buying premium is implied volatility, and that's vega. Of course, implied volatility rising can also be your best friend. But then again, do you really have an opinion on volatility, or are you hoping to get lucky? And this is where a lot of people end up at. They're so focused on price that they're not understanding where the volatility is at. And once we're done with the presentation, if you want to see some examples and kind of work through a few live examples, we can do that. I have my platform open behind me. I hear some orders going through. So moving on to the next slide here, implied volatility factor. So I know this is a little bit thrown at you, but we look at this again at the Black-Scholes just to keep it simple, all American style exercise, and we look at the call price of all of them, and we see that the volatility effect on these are ones at 35% with a delta of 50, same delta at 50. These are all at the money options. But you could see of how much more of the call price, the extrinsic value, will be if volatility is at 35, 71, and also 120. So sitting back and looking at this, what can we deem from this? Well, if implied volatility is 2 times what it normally is, that call option, that same at-the-money call option, is going to be $8 for this. And if you remember in the 2008 financial crisis, volatility, the VIX, which is the volatility on the S&P 500, was at highs. And what a lot of option traders were doing is that they were buying for plays of like a bounce in the other direction, or even with their puts, they were buying these volatility, these high-priced volatility options, which already cushioned, already priced in the move that the market thought was going to occur. And once it did move or didn't move at all, that premium got sucked out of it. And that's why, especially in 2008, for a lot of option traders, they really struggled. And the reason why they struggled is because they weren't understanding of volatility. And looking at this and just looking at the volatility picture of how it goes from left to right in a higher pace, you can see how much more expensive that option is. Now, if we're on the right side of that volatility, you can see with price not even doing anything, how it can double your option contract just by implied volatility going into it. So the volatility factor, oftentimes implied volatility will get elevated ahead of an announcement, such as a binary event or an FDA announcement, so on. We see it with pending FTA releases and earnings, basically anything that causes uncertainty. Uncertainty meaning that the market, there's an event that's coming up, we don't know which way it's going to go, or we don't know the news, so what we're going to do is we're going to put that into the option contract to price it in already. So a lot of times it's going to be much greater than what the actual reaction is. And that's usually about 75% of the time. So once that uncertainty disappears, that volatility gets crushed. Implied volatility can get elevated from supply and demand factors this can occur from unusual option activity. So this is something I cover a lot on my website, optionsizzle.com, and like I said earlier in several slides of following unusual option activity. This one was one that was from 2 days ago that I took, and it's AZN. And you can see here that implied volatility actually increased about 11%, or 11 points. And with that, because of that move of implied volatility, well, kind of backtracking here, there was unusual activity in this one, unusual option activity, which was about 18 times its 22-day average. I won't talk too much about that, but that's exactly what happened. What was occurring is that there was a high demand for these option contracts, so there were buyers coming in. Now, because this unusual volume was coming in, market makers, not real people on the floor, but systems, computers, see that, and what happens is that once that's triggered, where all of a sudden it's, oh wow, we're showing this bid and offer, but all of a sudden it just got scooped up, automatically they move that price higher. What that happens then is that moves implied volatility as well. So if you think about it as a carrot and a donkey with a stick in front of it, that's kind of what happens. So these people that really want it, they're just going to keep paying up and up. That's where the edge in following unusual option activity is at, but that also increases implied volatility at the same time. And it's important because you'll hear a lot about people buying these calls or these puts, and CNBC does it with that Fast Money show. And the thing that they don't tell investors is that implied volatility is higher, and also you don't want to follow those same people doing the same thing, because if you buy those calls, they bought it earlier, now you're buying a higher implied volatility. So going back to this, if we first started seeing this unusual option activity when volatility is at 35%, all of a sudden, by the time you hear about it, and a couple hours later, it's at 71%. But you're not understanding until you went through this presentation how implied volatility affects options. Now you see it, you saw it earlier at 35%, and all of a sudden it's like, wow, it's 71%. Of course I don't want to go along that call. That's way too much. I'm going to look to do something else. And that's where this is really going to help you going forward on being more successful, because when you look at these levels, now you're going to be like, no, I don't want to pay up 2 times the amount for my option contract that I could have got earlier. I'm going to do another option strategy instead that's going to create a higher probability of success and actually take advantage of that high implied volatility. So if you're going to be trading options to make directional bets, which you should, there are times where you should be making directional bets. Last week, myself, I made a directional bet on Twitter, and it paid off because it was oversold. It's something that you shouldn't be doing all the time. You have much more higher chances of success when you look to sell options, but there are times where you should be making directional bets on an underlying. What you want to do is reduce the role of time decay and implied volatility against it as well. So we've talked so much about implied volatility. So let's talk about time decay, or theta, and let's look at a couple examples here. So this is a little bit of a tough slide, and when we look at these options, these are the first part of it is options expiring in 3 days. The next one is 31 days, and then that one is 81 days. So without looking at a time decay curve, usually the most decay on an option happens between 30 to 0 days. And when we understand that and we go further out, we buy ourselves more time, 81 days, well, we kind of pad ourselves because it is going to lose value, but it's not going to accelerate as it does in 30 days. So expiring in 3 days, if we look at a 75 delta, which is in the money, and then the 53 delta is at the money, and then that 23 again is out of the money. When you start going from left to right, you see the intrinsic values change. And the key component is you always want intrinsic value, especially when you're playing direction. You want as less extrinsic value as you possibly can and more intrinsic value. So you can see here with the at the money option, Just need to clear my throat real quick. So the at-the-money option had more extrinsic value, and the 23 delta, you can see, has the 31 cents extrinsic value. So the at-the-money options carry the most extrinsic and really carry, you heard this probably in other books and resources, that at-the-money carries the most extrinsic value, which is the case. So when we look at the options expiring 31 days, you can see that options become more expensive, and this is what really affects people's decisions, because they go, well, I'll just buy the cheaper option. But when you pay up, you get a better option, and it's really understanding that intrinsic and extrinsic value. So even at 31 days, you see the 72 delta at $7.10. The intrinsic on that is $5. So you're only exposed to that component of time and volatility of about $1.98. The at the money is $3.93. And then there's no intrinsic value on the 25 delta, and you have $1.41, so it's all extrinsic. Same thing as the 50 delta. And then the 81, you can see the extrinsic is $4.58 on that 48 delta. The 23 delta, $1.68, and you can see that there's just more value with that 75 delta with the intrinsic value compared to that extrinsic. You have less extrinsic value on most of these when you are in the money compared to at the money, and you do, yes, get a cheaper option at that 25 delta, but those out of the money 25 deltas are at a 75% probability that those expire worthless. That's why they're so cheap. As we discussed, the biggest issue premium buyers that buy options, puts and calls, have is that they either are getting the time or volatility factor wrong. But there's a way around this that will reduce the role of time decay and exposure to volatility. First, buy options with a high intrinsic value. For example, buy an option with a delta of 70-75. That's why a lot of my examples were 70 to 75, because I really want to emphasize the fact that to have the most success directionally and use leverage properly, you want that intrinsic value. In many ways, this could be viewed as a stock substitute with a built-in stop. Now, I know a lot of people get into options because they look at those out of the money options and go, well, I want the leverage. I don't want to, if I just want stock, I'll just play stock. Well, you get more leverage still with the 70 to 75 in the money option than you do with the stock. So I don't want you to go on that soapbox. But when we look at that delta, we are still having some extrinsic value, but we're using leverage in a proper way. The benefit of this approach is that there isn't a whole lot of extrinsic value, like I said, in the option premium. In fact, if the stock doesn't move much, you won't get killed in time decay. And the great thing about this as well, which it's kind of just a little bit of a tip after I talk about the next one, but we can offset that whole factor by using another option, by selling an option on the other side. So if you're long a call, you offset that time decay that might happen by selling a put as well, which is very directional, but we won't go into too much detail about that because it could get a little bit more complex and there is more margin that's required for that, but that's how we can offset that. What time frame should you select when buying options? Well, this is really going to depend on your opinion on where you think the stock will go and when. Now, I know this is probably something I've heard many times as well, and it's really true at the end of the day. It's that it's dictated on when you think it is. So you start a stop clock right now. You have to think in your mind and try to project it out as best you possibly can. I think it's going to happen within this time frame, and add a little bit more time to that time frame to make sure that you have enough time. So it's very important to do that because there's not a blueprint, there's not an exact science to it. There's a lot of people that I come in contact with, well, Josh, give me a cheat sheet. Give me a cheat sheet of how this works. There's no cheat sheet because it's all random at the end of the day, and there's no way that you can find that out, and that's why it's more of an art than really a science. The beauty behind selecting deep in the money options is that we don't have to worry about all that intrinsic value. So I keep talking about this because I really want you to understand this. that extrinsic value is not going to get sucked out of that premium as much as the at the money will. And that's very important. We're using leverage properly. I'll show you some live examples in a little bit if you like, but let's move on to the next slide here. The second idea, which I think is a more viable outcome for most people, is to buy a spread. It's also known as a vertical or debit spread. And they're all three the same thing. Spread, vertical, or they're both the same thing, a vertical and debit spread. The beauty behind spreads is that they bring down the cost and give you a better break-even point. The only downside is that they limit your profit potential. And I use downside and bite my tongue on that because there isn't a downside. When we look at pricing and we look at stocks and price moves, everyone says, well, I don't want to limit my profit potential. But when you limit your profit potential, you increase your chances of success. Well, Josh, I want unlimited profit potential. There's no such thing as unlimited profit potential. You have just as much risk with that theory than you have actually doing to the downside. So what I mean is that some people say, well, I don't want to sell a put naked because that theoretical risk is there. Well, the probability of that actually happening is very limited or very small, the same way of your unlimited upside potential. And that selling that put actually has more of an outcome than it does with your long call theory of I want this unlimited profit potential because I think it's going to make 1,000%. I've never heard of an option that's made 1,000,000%. So, if you're going to continue to look for those, well, you're probably not going to have much money to be able to continue to look for those. You're going to have to do it in your paper trading account. So what I really want you to understand is that limiting your profit potential is going to increase your chances of success dramatically. And by capping it, we want to do that because we don't want to look for opportunities that are going to be home runs, what people refer to. We want to make sure that we do it in a way where we can continue to be consistent and we actually make money at the end of the day. This is really about making money. This is not about your ego or you called the stock right. It's about actually making money and making your hard-earned money grow so you can live comfortably in the future on your retirement. Not about the fact that you picked Netflix right and you had an option that went up 1,000%. That's great. However, I would rather have a 50% return and have much more money at the end of the day with a higher chance of success. So by buying an in-the-money option and selling an at-the-money or out-of-the-money option against it, you are reducing the effect of time decay and volatility. It's another way to play for a directional move without worrying about getting time and volatility aspect correct. So this is, again, kind of that step forward in understanding options and really getting very knee-deep in it, because when I talk about selling an at-the-money option, the theory or the thought would be like, well, Josh, you're not really making much. You're not going to make too much on the upside. But if we understand that implied volatility factor, well, we can, because if that goes lower, we can still be wrong on the price direction and still make money on that overall spread. So if we look back at our Facebook example several slides ago, the options that were expiring 31 days, the stock price is at 62.62 on April 1st. We look at a 72 delta, which at that time was the 57.5 strike, and that was priced at $7.10. We look at that 25 delta, which was at the 71 strike. That one was priced at $1.41. Now, just looking at this, that 71 to 62, that's a big move for a stock. In comparison, when you start talking about percentages and like price movements, 62 to 71 is a very big move in 31 days. And again, when we look at 31 days, that's where that time and volatility really crushes an option. That's where it accelerates the fastest. So $1.41 to $7.10, yeah, it's about 5 times more than the one option compared to the other, but you're increasing your chances of success. By going further out and buying the cheaper option, you are decreasing your chances of success dramatically. But if we look and we combine these, what do you think the intrinsic and intrinsic value of these options would be. So the 72 delta, what do you think that intrinsic value is with the stock at 62.62? And I'll give you a few seconds to calculate it and enter in the chat box if you like. But it's a good little stopping point because of all the information that we've put together, and I'll get a drink of water as well. Okay, so we'll move on to the next slide here, and keeping in mind of that last slide we looked at, the options for 31 days, the price at 62.62, 72 delta, 25 delta. If you bought the spread, so if you bought that 72 and sold that 25 delta, the total cost would actually reduce to $5.69. In addition, the intrinsic value would still be at $5.12, because that's what the spread is. However, our extrinsic value would decrease by 57 cents compared to that $1.98 if you had just bought the call outright. Your break even on this trade as well has gotten better too. It's from 64.60, the original break even, to 63.19. By just selling that 71 call, we reduced our exposure to time decay in implied volatility by doing that. Why? Because we sold that 71 strike. What we're saying is that, Mr. Facebook, we don't believe that you're going to get to 71. We also understand that there is a 75% probability that this is not going to happen. I think you are going to go higher though, but I don't think it's going to go that far within the next 31 days. And that's the lovely sounds of Chicago that you hear coming to you live in the heart of Chicago. So when we understand the implied volatility, we understand the time decay, we understand the probabilities of options, we look at this and go, well, Josh, that kind of makes sense. You know, I don't think it really is going to go to 71. Why wouldn't I sell that 71 strike? And exactly the reason why is because we not only reduce our cost and increase our probabilities of success, but we get better. We get a better opportunity to make money at the end of the day if we're right on our price direction. Let the stock go past 71. Who cares? You got it from 57.50 and a half all the way to 71 if that does happen. Let someone else take the risk. You know, you don't have to be the star picker or try to be the star picker, because no one is of you know, having that one strike or that one option that increased in value. You might get it once in a while, but when that once in a while is not going to make your account move in the right direction. So that's going to wrap up what I have. If you guys have any questions, it took us about 43 minutes here. So if you have any questions, feel free to type them in. If not, and you want to see some live examples or want to see have some questions about some things, we can talk about it then.
Josh, this is Greg, your host. We actually have a question from Joe. He wanted to know, earlier you had given a sample and talked about some unusual option activity you had seen. He wanted to know what website or trading platform you use to identify options with unusual option activity.
What platform? Ooh, it's a tough question. There's a report on the website that I have, Option Sizzle here, and you can join there. I'll talk more about it with you in that free report, and you know, then there's another report that's part of it that will talk about what I actually use and how I use it. So it's a little bit more of a whole presentation, but it's kind of a little bit of a complex process.
Okay, thanks, Josh. We do have quite a few people saying, let's see some live examples.
Okay, well, good. What kind of examples would you like to see? Are we asking about, like, if I were to play this today, what would you go with, or how would it look like?
Let's see if we get some specifics right now. Let's see. Bill wanted to. He said, speaking of uh, Facebook, I was thinking about buying June Facebook $60 calls. Do you like this strike based on current deltas? Where do you go to find deltas on specific stocks? Was a follow-up question.
I missed it a little bit.
So he was talking about buying a June Facebook $60 call. That's
Okay,
FB, right?
gotcha. So, one of the things I do here, and this is probably a good example, is that I use Thinkorswim as the main platform. There's no plug intentionally there. It's just actually what I use. And I'm just going to close the site here so we get more of a view. One of the things that I look at is an average implied volatility. And this is something I look at pretty in depth, and it helps me identify just quickly where implied volatility is at. So like we've talked about this whole presentation, understanding implied volatility. If you look here, the implied volatility, the average has oscillated. So I'll look on the option chart as well on Thinkorswim, but right here, right now, implied volatility is it's a little bit from its range. It's kind of a little bit on the higher end. So if we go look at those options in June, what I would be looking for me, if I were doing this, I to myself, if I'm bullish and I'm bullish over the next, looking at the next few days, maybe the next few 7 days, then I would look at those June options, and sometimes I even buy myself the July options depending on my viewpoint. But if we look here, with prices at 62.45, pretty much exactly the same price we're talking about early in April, what I would be looking at here, as you can see on this, is at the delta. And I would actually be looking at a delta of about 77 here. So these 55s are probably where I would like to go. Just because we don't have a 75 delta, this is going to be good enough here. So for me, I would do something such as this, where we're at the 55, and that would give me that directional aspect. For this, I would actually cap it off, and I would honestly probably cap it off, for me, if this is something I were to do, I would cap it off here at 70. $8 in a $60 stock, it's a pretty decent move, and it's pretty nice. So it would look like something like this. Those working orders from before, but what did I say? 70. So we would look at about a $7.18 debit. It would give us about 58 days to expiration, and for me, I obviously have done this for some time. I've been doing this for about a decade. But if you look here, we have some resistance here at some of these levels, 67.5, 72. So when you're looking at prices, you want to be aware of that kind of stuff, and that's where I would, not saying that this is what I'm going to be doing or what I would do, because it's not, but this is where I would structure it and how I would structure it. I also probably, and I had mentioned this earlier as well, is if we look here, with Thinkorswim, they actually give you statistics on options, and you can see here that the IV, this is rank, this is actually above the rank, and like we talked about with implied volatility, ranges from 0 to 100 typically. So this is right here, just a little bit above its mean, or the 50%. So for me, I probably would look at something like even selling a put to offset some of my risk as well, and that probably would be at the 50 strike on something like that. And this is where we can really start to maneuver with options and really create favorable opportunities by doing that, because what we can do is we can really offset some of that decay that happens, even though we did sell that out of the money option, but we still have some things working in our favor where we do have those 50 options decaying. Maybe the other options decay as well and prices don't really do too much. We can still create a profit if we're wrong and adjust that position to buy ourselves more time. So, if this was something that we thought was going to happen within 10 days and it didn't, well, at that time I would probably roll out to July, because you want to be proactive instead of reacting. Being proactive means that you adjust a position when it doesn't happen in your time frame, and buy yourself more time directionally, something that doesn't happen. So go on to another question if you like.
Yeah, Bill, who did ask that question about Facebook, did want you to look at those July Facebook calls too.
Okay. So, July would probably be the same thing as well. Um, well, actually, we have a 75 right here at the 75. With that one, on this one, if my time frame was at 86 days or I was getting this one, I'd actually scoot it up a little bit more. I wouldn't go so far in the money. I'd probably go here at this 57 and a half, because I do have myself some time for the direction to work. So if it was more of a shorter term time frame, I would, and shorter term being like a day trade or a swing trade, which would for me is referencing to, I don't know, about a week or 2 weeks, I would look at a 75 delta. Now, if I'm going out about 86 days, we're talking about 4 months. That I would pad it against selling an out of the money option, but I would also scoot in some of my delta as well, and I would kind of raise my delta a little bit higher, or sorry, raise my delta a little bit lower to that 68, just because I am directional on it, and I know that once it does increase a little bit, my delta will increase. And if I was still bullish on that position, I don't want my delta to go too far in the money. I would actually adjust it out. So I kind of threw a couple other curveballs in there, but if it's a shorter term trade and I get my move that I'm looking for, I'm looking at a 75 delta and I close out the position. Something that's more longer term to me is like 4 months, 5 months. I will go up higher or lower in the delta. So higher up the strikes, lower in delta. And what will happen is, because you get that price movement, this 68 delta will become this 75. What I will do then is I will lock up those profits, and then I will adjust that position higher, because I do still want to maintain that direction if I still have it, and also at the same time adjusting it because I don't want to go too far in the money. We don't want to be in an 86 delta, because you can see here you have some liquidity issues as well. Something I didn't talk too much about. I know it's all kinds of stuff. Options become more than just an hour presentation, but I would be looking at I would be looking at the volume as well to make sure that I wouldn't have a problem, because when you get too far in the money, sometimes you won't be able to get out of it unless you just exercise it, which is going to cost. If you have the capital, you can do it, but for some people it might be a little bit too much on a stock like Apple or Google.
Okay, Josh, thank you. We have another question. Debashish says they would like to see, I want to see example of how to take advantage of sudden IV explosion due to high volume.
How to take advantage of it?
Yes.
Well, the best way to do that would be to sell those options. Obviously, it's going to be dictated by each situation. But the best way, if you're doing it directionally, like we just talked about on Facebook, and wanting to take advantage of it, you would want to sell that option. So you either buy something that's in the money, and because my presentation was so early, I haven't even got to look at anything that I would find unusual option activity. But if we can think about a few days ago, I picked this one up, and I have a Twitter that I'm pretty active on, and Facebook community as well. Late on Friday, we actually picked up, or I picked up some unusual option activity. I posted it for our followers on Facebook and Twitter, and what happens is that these options start to increase in value, like I said. So this is an interesting one, because the question would be, well, how would you have played this one? And if you look here, these were the options that were actually very active, and they were buying these at 35 cents on Friday, late on Friday, which is very unusual. People that want to buy options late on a Friday into the close, it's always a little iffy on that one, because you're buying a decaying asset. So the way that I would play this one, because the implied volatility did move higher, is I would sell these 5 strikes. And a lot of people would say, well, Josh, you're selling that 5 strike. Why are you going to sell that? You're going to cap your upside. Again, the stock is $4. A dollar move in a $4 stock is a large percentage move. And what happens is that even though that the implied volatility on these options are moving higher, the implied volatility on these individual options, even though they don't show it right now, they are increasing as well. And that's how you would offset that implied volatility. So if we just look here at court, again, we look at the implied volatility, we look on Friday, this is exactly what I'm talking about here. So this right here is exactly the problem that happens. This is the peak of this implied volatility here. You can see it's dipped down because it's moved in whatever the news that came out yesterday that got it moving, came out of it, and you see a little bit of a pause today. But even though that they got this direction right, implied volatility going against them, it doesn't increase the way it should, because if they had implied volatility moving higher and also prices, they would have gotten a lot more for their money. That's why you want to look to offset it. The other way is actually to sell that option. So selling this 4 strike, and then, well, it would have been something like this. You would have sold the 5 strike and then buy the 5 strike in June. So you sell, if you notice here, this is implied volatility for the front month. This is at 173, at 128. I would have played the difference of this because I know that that move higher, if that were to occur, the front month is going to decrease because it's less than 30 days, while that June contract will hold a little bit tighter, and that difference is where I would capture it. So those are 2 ways that you would look to do that.
We had a follow-up question, but Vega in June is higher, the person said?
The Vega in Facebook, or?
I think the example you were using. In this example, sorry.
Oh, yeah. Well, right here, June. No. We're looking at implied volatility. It's more active. It's always going to be more active. Front month options that are closer to expiration are going to have a higher, typically, implied volatility level. The front months are always going to be high, especially something like this. Now we look at something like Netflix, where it's already came out. You can see that the weeklies still have, because they expire this week, they're much more sensitive, and next week as well. But you can start to see that volatility start to skew lower.
The person asked if you could open the chain to show the Vega.
Oh, well, I would have to play around with this, and I don't want to change my settings right now, so I apologize on that one. They could do it on their own chart.
Yep, thank you. Okay, we've just got a couple more minutes if anybody has any other questions. Waiting for a second. Okay, Josh, it looks like we don't have any other questions at this point, so I want to thank you for a great presentation and thank everyone for attending.
Absolutely. I appreciate the opportunity. And those that are interested, if you want the presentation that I have, I think, like they said, that they can they have it on the Money Show. If you want the slides, you can email us, contact us, or go to the website optionsizzle.com and just send me an email, Josh at optionsizzle.com, and we'll send it over to you. Also, you can access this free guide on unusual option activity and my thoughts on playing direction a little bit better on elaboration from what the presentation talked about.